Welcome, everybody, to the webinar. This is Todd Zempel with Gordon Asset Management, and today we're sharing with you a brief market update as of June 28th, 2022. So the presenters today, we have Glenn Moore, who's a partner in the firm, myself, Todd Zempel, also a partner in the firm, and then the man, the myth, the legend himself, the founder of the firm, Joe Gordon. A quick few disclosures. So again, our firm's Gordon Asset Management. We're a registered investment advisor. The information we're sharing with you today is for informational, educational, and entertainment purposes only. So if you have questions, if you want to implement any investment strategy, we absolutely recommend you speak to a professional. I'd like to start at the end. So we do have some resources for you. So if you are interested in investing, like to know what's going on in the markets and also planning, we have a podcast, the Gordon Asset Management Podcast. You can search that on Spotify, iTunes. With the podcast, it's pretty interesting. We like to interview interesting and smart people, mutual fund managers, folks that really are dialed into the market. So that's long form conversations with really smart people. We also have a YouTube page. So if you'd like to see more content that we pump out, you can visit YouTube, search Gordon Asset Management. And then also our website, wealthqb.com. So we are within about 48 hours of relaunching our website. With the refreshed website, there will be a lot more content out there. There's a lot more videos, a lot more calculators, up-to-date blog posts, and that kind of thing. So I definitely recommend you check that out if you hadn't. And then last but not least, schedule an appointment. If you have questions, you can reach out to us directly. Just go to our website, wealthqb.com. There will be a big schedule an appointment button in the top right-hand corner. So we're happy to have conversations with any of you if you have any specific questions. You can also shoot us an email at info@wealthqb.com. That said, let's go ahead and jump right into the material. So I will cover a few general slides and then pass it off to Glenn to go into some more detail on a few things. So year-to-date, markets are down. So the chart you see in front of you is data through market close yesterday. And what you can see there is the NASDAQ is the worst performing index out of the ones presented here. So the NASDAQ is tech heavy. You can see it's down 26% year-to-date. The Russell 2000 index, which is small caps, down 20% year-to-date. The S&P 500, large cap U.S. Stocks, down 17% year-to-date. And probably the big surprise is the bond index. The U.S. core bond index is down about 12% year-to-date. What's interesting to show is if we take a step back and look at a broader time horizon. So if we look at markets going back to the good old days of December 31st, 2019, pre-pandemic, pre-Russia-Ukraine invasion, the good old yesteryear of December 2019. You can see on the chart here that if you were investing in stocks since then, you probably have done pretty well despite suffering some drawdowns year to date. You can see, again, the NASDAQ, the tech-heavy NASDAQ, up almost 40% over that time period. The S&P up almost 20% over that time period. The Russell 2 small caps up about 7.5%. And again, sort of the interesting thing here in this quantitative tightening type environment that we're leaning into coming out of the quantitative easing monetary environment, you can see over that time period, you would have lost about 10% in bonds and pretty much lost that all this year. So that provides a nice little historical context to where we are currently. But then one last chart that I'll share, and this is one that we covered in the last presentation that we did. And this is probably one of the charts that most folks, when we go out and meet with companies on their 401k plans and talk to all the participants, this is one of the charts that people find the most interesting. This is a chart of the S&P 500 index going back to January 1st, 2002 through 12/31/2021. If you invested $10,000 in the S&P 500 index over that period, if you would have just put it in there, left it invested, not thought twice about it, as of December 31st, 2021, you would have ended up with about $61,000. If you would have missed just the 10 best days in the market, you could see your results would have been less than half. You would have ended up, still would have made money, but significantly less, about 28,000. Now, the thing that everybody asks and everybody takes an issue with when I show this chart is they say, well, what are the chances I would miss the 10 best days in the market? Well, the purple bars on the chart show exactly when the 10 best days in the market over that time period actually happened. And you can see from the chart, it only looks like there's a couple lines because several of those days are so close to each other. And what's interesting is you look at when those best days in the market happened, they happened sort of in the midst of a bear market. So if you look at the little chart, you can see a bunch of the best days happened in 2008 in the midst of the global financial crisis, and in 2009, sort of coming out of it. And also in 2020, in the midst of the COVID-19 pandemic, right? Everybody thought the world was ending in March of 2020. A lot of our business clients were unsure where their businesses would be in the coming years, or if they would even have a business. But believe it or not, some of the best days in the market happened in the middle of that. So the main point here is, if you are a long-term investor saving for retirement, you're not using this money in the next handful of years, for most folks, it makes sense to stay invested through the volatility. So that said, Glenn, I'm going to go ahead and hand it off to you to dive into some of the additional details here.
Great. Thanks, Z. And for everyone who doesn't know me, I'm Glenn Moore, and partner at Gordon Asset Management. And Joe Gordon and I are going to walk through some of the market dynamics that we're seeing right now, and also provide a little bit of historical context for those who may not know. So this is a chart that I thought was pretty interesting. This is from Goldman Sachs research. And what they're showing is they've bucketed recessions based on the characteristics into three different groups. And so you have a secular recession, you have a cyclical recession, and then you have an event-driven recession. And event-driven is what we had in 2020 with the pandemic. Obviously, you have an exogenous event. And what you tend to see with those is that they're pretty short-lived. And if you look towards the bottom where you see February 2020 through March 2020, it lasted 1 month. And then the time to get back to where we were prior to took about 5 months. And you can see the previous event-driven or exogenous recession was in August of 1987 through December, and that lasted 3.25 months, or 3.25 months, and you got back pretty quickly after that, about a year and a half. Cyclical recessions, which are more of just kind of your classic recession, where you have the business cycle slow, you have consumer confidence wane, and you're just kind of naturally going through the process of the business cycle. Those tend to last a little bit longer. On average, they last about 2 years. And so when you look at the average and the median, it's usually roughly 24 months. So far, we're kind of 5 months in. So on average, we're kind of maybe in the earlier stages of this recession. But again, those are just averages. That means that half is longer and half is shorter. And then your structural recessions or bear markets, those are more like the 2008, 2009, where you had a ton of leverage and you had a lot of risky and speculative behavior that was going on, and those are the longest ones. And so on average, those can go or last anywhere up to 4 years. And so I don't think that we're in a situation or scenario where we're in a structural. I think, possibly it could be a combination of cyclical and event driven, and the event driven being supply chain disruptions that we've seen with COVID lockdowns in China continuing to persist, and just staffing and workforce issues that we still, and when we have conversations with business owners today, one of the persistent themes that we're seeing is that staffing is still a very difficult issue. And so what that means, in my opinion, is that I think that if we have this kind of combination between cyclical and event driven, it could be somewhat of a shorter bear market and a quicker time to recovery. But we'll wait to see how that plays out. So this is a updated slide that we showed on our last webcast, where we're looking at the projections for domestic growth in the U.S. And what you can see is that in 2020 and 2021, those were extremely unusual years where we had massive declines in growth, followed by massive acceleration and increases in growth. But what's interesting is that when you look out into 2022, you kind of see that we're projected to go back to what was trend prior to the pandemic. And so when you look at 2019, we were kind of in this very slow growth, kind of mature economy where you're not having these wild swings in GDP growth. And I think that when you look at the projections, if we go back to an environment like that, I would expect to see more normalized type returns, and you won't see such wild swings and heightened levels of volatility that we've seen in the market thus far. This is a good chart, basically showing that if we do have a recession, or when you have periods of time where consumer confidence is at its lowest points, generally it's a good time to start looking to allocate capital to stocks. And so if you start on the left side, you can see when we hit a low in consumer confidence in 1975, in the following 2 years, basically, the market rebounded 22%. And then again in the 80s, when we had consumer confidence hit a low, over the next 4 years, albeit it wasn't as robust of a return, but to 1984, you saw a 20% increase in the stock market. And so it can be, in some cases, it's the hardest point to invest is when the consumer confidence is at its lowest point. But generally, you want to fade what the crowd is doing and fade what the broad consumer confidence levels are showing. And generally, those are the best times to actually be putting stocks to work in a meaningful way. So when you look at what inflation expectations or projections really are for the next 4 quarters, I think that this is when we have another slide that we're going to go through, but we've been pretty staunchly in the inflationary camp, and we were pounding the table on inflation going up, actually going back into the 3rd and 4th quarter of 2020. And even though inflation, we think that we could be reaching an inflection point in the pace of growth, and you can see in the 2nd quarter of 2022, we may be putting the top in right now, and in the 3rd quarter and the 4th quarter of this year, we think that inflation could actually start to wane. And even though the levels of inflation are still high, we think we're going to be going into a period where the pace of growth will be going down. And so we will show you in the next few slides where we think that you can actually capitalize on these economic dynamics and possibly try and avoid some of the volatility in certain asset classes that may not like higher levels of inflation. And so we kind of look to history as a guide, and we have found this chart in the Rosenberg, or David Rosenberg, who we use as a research provider. You can see the 10-year note, and so long-dated treasuries, which is a good proxy for those. In inflationary environments where you had high levels of inflation, but you had negative GDP growth, which the first quarter of 2022, we saw negative annualized growth, and the second quarter is not looking much better. We still had periods where you saw a very rapid increase in interest rates, followed by a period of decline in interest rates. And so, just as a refresher for bond math, when interest rates go down, bond prices go up. So that's a good thing for bonds. And we think that this actually might be an environment that we're going into where growth is going to have more of an emphasis on the direction of interest rates and thus the prices of bonds, and inflationary concerns may be taking a back seat. And this is now showing the inflation or the change in inflation year over year. And as you can see in the early 70s, the mid 70s, and in the 80s, even though you had high levels of inflation, you can see in really in the mid 70s and in the 80s, where we had inflationary levels at 15% compounded. The previous chart, I think they both kind of work in tandem. Even when inflation is high, if the pace of inflation is going down, that can be actually very good for bonds. And so those are some of the dynamics that we're looking at to give us a little bit of guidance on how we should be investing and what ways we should be investing money. So this is a chart that shows the sector exposure of the S&P 500, which we use as just the broadest measure of a stock index. And one of the questions that we get pretty regularly is, well, is this going to be an environment where stocks are going to do poorly and returns are going to be very hard to come by? And one of the things that I think we like to do is we like to be a little bit more thoughtful in not just looking at stocks broadly or broad-based indexes, but looking at what the composition of those indexes are. And you can see this is a snapshot as of the last month end, and technology is a 25% constituent in the S&P 500. Whereas you look at something like energy or materials or even industrials and real estate too as an asset class, those are traditionally your inflation hedges that do very well or can do very well in inflationary environments and even in stagflationary environments. But if those makeup of the index, if those constituents are so small, they're not really going to move the needle one way or another. Energy this year is up, I think, 40 or 50%, and it really hasn't had an impact on the broader index. Whereas you look at technology, which is a quarter of the makeup of the S&P 500, is down 30%, and so obviously that's had the highest weighting on the returns or the driver of returns in the S&P 500. And so if we have an environment where technology is going to be in a lag because you have interest rates are higher than where they have been, which was on the zero bound, and essentially making money cost nothing, it's a lot more difficult to be profitable when you have when the cost to borrow money or use money actually it costs something. And so we think that there might be technology as an asset class may not be the best place to invest in, and that certainly could cause or be the driver of poor returns on a lot of broad-based indexes in the near future. And so this is, to me, it's just instructive to look at the makeup of the different indexes that you're benchmarking to or that you're looking at, and understanding what the drivers of those returns are. So just to wrap it up, this is another chart from David Rosenberg, and he shows what worked in the 70s, and using that as just a little bit of a guide if we think that we're going to be going into a slow growth and higher inflationary environment. You can see clearly what worked well on a nominal basis, and so including inflation. But then when you X out the impact of inflation on a real basis, which really is more what you should be paying attention to, what worked and what didn't work. And so gold was the biggest beneficiary during that time period. Obviously, commodities and real assets are a great way to hedge your portfolio from inflation. and CRE is commercial real estate. So you've got kind of maybe residential real estate and then commercial real estate. You've got the ag complex and food, and then you've got also metals and then other textiles that play into the ag complex. And so then what doesn't work well really is the Dow Jones and the S&P 500, just because those are going to be very broad momentum based indexes, and when you have a constituent of that index become outsized, mean reversion just says that over time it's going to come back down to earth. And so this is an interesting chart where I think that it shows that even though we may broadly have poor returns for the next several years because of the impact of inflation, there are ways to make money and to profitably invest. And I think that that's the important point to remember, is that that if you're thoughtful about how you're investing your money, you can actually make money in difficult periods of time.
Well, thanks, Glenn. And before we get into the Q&A, and again, if anybody has any questions, you can submit those via the chat function. Before we start addressing some of the questions that were actually emailed in before the presentation, Joe, I'd like to get your take on things. You have the benefit of having lived through and worked through this environment in the past, an inflationary environment in the past. What are your just general thoughts on where we are right now in the economy and in the markets as a whole?
Well, not to overstate Rosenberg Research, we do pay for that, and it's not inexpensive, but he has been an inflation hawk, that this was coming and it wasn't transitory. I'm reminded today in the Wall Street Journal and heard on the street column, there was an article that said the Fed can't fight inflation by itself. So I think where we are is a denial in the White House, regardless of your political persuasion, that they've had a poor energy policy here. And that is why you see $6 to $7 gas per gallon in California, $5. I paid, I think $5.50 is the most I paid for 93 octane. So literally, when you look at the inflation, there's an energy component and there's a food component as well. But where I think we are is we had a negative GDP growth in the first quarter. We're pretty convinced we're going to see negative or flat GDP growth in the second quarter. And even though there's a lot of positive, uplifting talking heads on CNBC and Fox Business trying to walk that risk back, the data just doesn't bear that out. David Rosenberg today mentioned that consumers basically are not buying what they want anymore. They're buying what they have to. And so there's a rotation to all types of behavior modification, from people not filling up their tank with gas. They do a half a tank and up the prices less next week. People are not eating out as much. They're actually stocks of like Heinz, Consumer Foods, and Campbell's Soup are up year to date. So you can see where people are going. It's pushing stock prices up. But one thing Rosenberg reiterated is that in every period of time we've had a consumer-led inflation, consumer-led recession dating back to the 40s, when the S&P was also down 20% or more. We've had a recession. And so I think we're in a recession. Kathy Wood, who is an extremely aggressive investor in the disruptive and thematic stocks, was on CNBC this morning saying we are in a recession. So you're seeing it from every side of the commentators, from the aggressive growth investors to conservative investors, that it feels like we're in a recession. So the Fed is going to spike one more time, 75 basis points, and then I think they're done, because they won't be able to without basically just destroying the economy anymore. And I think it's pricing in, because the 2-year Treasury and the 10-year Treasury are trading within about 10 basis points of each other, meaning about 3.1 to 3.2%. The last thing I would say is that there is some hope, and that is that there's you're having a repricing of stocks. You see most of the carnage in the tech sector, which you guys mentioned, but there's also a shift to value. When the Russell 1000 Value Index starts adding tech names to it, that tells you that there is serious blowups in the tech sector, to where now they're trading at reasonable valuations, not growth at any price. And you see that with stocks like Zoom, and you see it with stocks like Qualcomm. You can get Qualcomm at a generational low, trading a little bit north of 10 to 12 times earnings, paying a 3% dividend, which for tech stocks, a pretty good thing since they own tons of patents. And then you also look at a Zoom, which is the poster child for excesses. It traded at about 570 at its peak in 2020 after their IPO, and it's trading at 118 bucks today. It was at 84, 85 bucks about 3-4 weeks ago, and at 20 times earnings. Now it's at 27. So there has been a repricing. You can, this is why index investing is probably not a good place to be now. It's more selective, pick the sectors, pick value. And even after 2 weeks ago, energy had a big sell-off of 17% in 1 week. It went from up 60% this year to up 40. That's still pretty good, but as Glenn pointed out, it is a small piece of the S&P sector. These companies will continue to make mint money and pay 2 times the dividends they're used to, return cash in the form of buybacks, but simply because they can. And you can't blame them, because that sector was left for dead in March of 2020 when the pandemic began. So basically, I think we're in a recession. You're going to see a further repricing of stocks when earnings come out for the second quarter. And when that happens, you could expect, and a lot of people are calling this, to see the S&P go down 10% more, and then we'll hit a bottom. So last week was an uplifting week, especially Friday, when most of the indexes were up 3%, but it really was a dead cat bounce, as they call it on Wall Street, or a slight little rally in a broad bear market. So those are my comments.
Yeah, that's perfect. And we had this slide on the side. It wasn't part of what we planned on covering, but I think with Joe's comments, it's important to bring this up and talk about this. So what this chart shows, it shows the forward price to earnings ratio of the S&P 500 index over history. So going back to the mid 90s, you can see right now the S&P 500 index is trading at about 16 times forward earnings, which is right in line with the 25-year historical average. So what that says to me is that, well, the market's actually come down from being pretty overly priced to pretty fairly priced. But to Joe's point, I think the concern is that if price to earnings is just a simple ratio of the stock price divided by earnings. If the denominator goes down, if the earnings come down, which everybody's kind of expecting earnings to come down following this quarter, will there be a re-rating in stock prices to sort of bring the PE ratio back in line with historical norms? So that's the big question. But where we are today, things are seemingly more reasonably priced than they had been over the past year plus. That said, again, submit those questions via the chat function. Joe, I'll throw one of the first questions out to you. So a lot of people like index investing because they can gain cheap access to various segments of the market, various asset classes or sectors. But in this environment where it's highly volatile, there's a lot going on. What are your thoughts on using index funds versus an actively managed fund?
I think that this is the period of time as markets are finally being freed up, especially the Fed ending its manipulation of monetary policy. And literally that's what's happening here. They're back taking the foot off the pedal. I don't think you want to be owning index funds at this particular level. And the reason is just that history has shown that value investing in a late stage of a bull market, which some would say now we're not in the 8th inning, we're in the bottom of the 9th inning, is that this is where active investing works, and it manages risk on the downside, but also you buy things that are really cheap that are beat up. And there could be no better example of that this year than energy. Active managers, though, have not had the courage to increase their energy allocations toward a 10% weighting, which would be a little over 2 times what the index is. And I've been disappointed by that. Yet we have clients that have had a 10% weighting that basically until after last week were basically break even for the year. And I think energy is going to continue to run. There are some companies paying 8 to 12% dividends in that space, and they're minting cash. So it's not just value. Energy is traditionally value in material stocks like John Deere and so forth. But I think also there's plenty of bargain hunting you can pick up on reasonable valuations, even in the tech sector, and mentioning Qualcomm a few minutes ago. So I just think you'd make more money when you're buying things cheap and being selective. I think value investing in, which puts a premium on balance sheet and buying things right than just a broad market cap weighted index approach.
Perfect. The next question, Glenn, I'll throw it out to you. And this is an all-encompassing question, but for somebody that is 10 plus years out from retirement, maybe you're a participant in a 401k plan, you're 50s or younger. What should you be thinking about? What should you be doing with regard to your 401k balance? How should you invest it?
Well, I think that the chart that you had up that showed if you missed the 10 best days of market returns going back to the early 2000s, you can see it. And as you mentioned, volatility begets volatility, and it goes both ways. It goes on the upside and the downside. And so the risk that you run is that if you're trying to play this game of timing the market where, if you're trying to get out before it goes down significantly and you try and get back in before it goes up significantly, the odds of you successfully navigating that, you'd actually would have better odds winning the lottery. And that was a statistic that was cited by a person from JP Morgan I heard on CNBC. She basically said timing the market like that, it's your odds are worse than winning the lottery. So take that for what you will. And so I think especially for people that have a longer time horizon, it really, I think the best saying is that it's not timing the market, it's time in the market. And so if you actually have the luxury of having extra cash on the sideline that you haven't invested, I would say probably now is the best time to actually, I wouldn't dump it all in at one time. I would probably smartly dollar cost average. And even if you miss a little bit of upside, if the bottom has been put in, which I think that we would probably say maybe not, which is why we would advocate for dollar cost averaging, especially at these levels. If you have that luxury, or if you're just continually participating and contributing in the 401k, looking at your accounts, rebalancing, getting back to whatever target asset allocation, or if you're in a target date fund, it's really hard to play this all in, all out game where you're either invested or you're in cash. It's just a fool's errand, and clearly no one has successfully been able to have that type of strategy on a regular basis, and they would be the most sought after investor if they were able to replicate that.
Now, Glenn, same question, but let's bring in the time frame. So how would you answer that question for somebody that's a little bit closer to retirement? I would say maybe within 5 years of retirement, or thinking of retiring in the next year or two.
Well, at that point, I think you really want to be looking at what risk are you really taking in the portfolio. And so, I mean, if you just look at the broad target date concept, is that as you get closer to that retirement date, so as you go from being 20 years out from retirement to 10 years to 5 years, you're really dialing down the risk in your portfolio, and you're moving you're not only moving money out of stocks and into bonds, which bonds traditionally have been a less risky asset class, but you're also being mindful of the composition of those stocks that you're investing in. And so, like Joe said, traditionally you're moving into more of a value type investment strategy where you want to own companies that are very high quality. They have good, sound balance sheets. They have adequate cash on the balance sheet. They have actually positive earnings. They have positive cash flow. And ideally they have increasing earnings and increasing cash flow. And they're growing their dividend. They're doing all the things that good, responsible companies should be doing, and rewarding their shareholders. And so you need to be mindful, in my opinion, of understanding what you own underneath the hood, and you're not just your stock composition isn't just yesterday's winners in the FANG components and semiconductors and Chinese tech stocks. Because if that's the case, you've been sorely disappointed this year because your equity piece is probably down 40 or 50 or 60%.
And then last question related to that. What about somebody who's actually in retirement? You're in the spend down phase of your life. So your cash is currently all invested and you're spending it down. Should that person think about things differently than the person that's approaching retirement?
Well, I think that those two are going to be more similarly related than the person who's 10 plus years out. I think that going back to that one slide where if you're not invested and you're missing the best days in the midst of the eye of the storm of the hurricane, if you will, the data shows that you're going to severely impair the prospects for your future earnings if you're missing those best days. And so, being mindful of how you're invested, and just know that for bonds this year, this has been a 3 to 4 standard deviation event to the downside, where this has been the worst return for bonds in a calendar year. If this were 12/31, this would be by far the worst year for bonds, and we're not even halfway through the year yet. And so I think that if we're looking out 6 months from now, that may be a different story, but we'll see. But I don't think that if you're thinking about pulling cash out because you don't, or putting your money in cash because you don't want to lose anymore, I think that the probability or the odds that you're going to significantly impair the ability of your account to recover goes up substantially, because you're going to miss those days on the upside where both bonds and or stocks have these great days to the upside. And so I would just say that this is a short-term time period right now where we're seeing this phenomenon of both stocks and bonds doing poorly. But I would expect, especially to Joe's point, if the Fed reverses course and pivots and stops their regime of raising rates, and that coupled with recession, I would be very surprised if bonds would continue to do as poorly as they have. And so that would actually be a good time to actually start adding to your bond portfolio, or just the notion of rebalancing back to your target weights, to try and make sure that you're maintaining the proper asset allocation.
Now, Joe, this question is for you. This is one that came in live. So the Federal Reserve is essentially tightening monetary conditions right now. So they're intentionally trying to slow down demand to cool off the economy. So obviously, when we're in this quantitative tightening phase of monetary policy, that the goal is to reduce consumption, right? To bring prices down, to get inflation under control. And obviously a huge component of that is energy. So, energy is the lifeblood that runs the economy. So Joe, what are your thoughts on long-term prospects for energy in the economy, and how these current inflated energy prices will filter through and affect the economy in the intermediate to longer term?
Well, energy prices, why I think it's a great place to invest long-term is because you've got a war between the everyday American who needs lower priced energy and probably drives their F-150 truck to and from 30 miles a day to a job site in middle America. And then if they're eating out, they're finding that it costs $10 to eat a Subway sandwich in most places and a drink. And so they're feeling it at the pump. I think that the fact that the Michigan consumer attitude survey of what consumer sentiment today came out at its lowest ever tells you that most Americans feel the country's not being run in their best interest. So with that, I still think you're going to see inflated energy prices. And it's a policy mistake at the White House. And everybody, you've heard it, go buy an EV, get over high gas prices. And not most people cannot afford a $60,000 EV. So I think energy is here to stay. It's a very unloved asset. And one of my best analogies about energy is that one of the reasons it's going to continue to do well is not only because the US operates 70% fossil fuels today. You can't just flick a switch and go to zero overnight, but some people in the White House apparently think you can. And I think they're using this tool of looking at, well, Germany pays 3x. Well, their energy policy has been an unmitigated disaster on the consumers in Germany, that they're paying 3 times for their energy than US workers pay or US households pay. So energy is to me like the cigarette industry in the 90s when they had the huge tobacco settlement, which basically eliminated all future competition to the marketplace and gave a cartel to the big producers like Marlboro, Philip Morris, and others. And then the only ones that could compete were Indian reservations because they are not subject to US law. And so what you had is these stocks just continue to pay out big dividends and do buybacks, and they were hated. I think that's what we have right now. That's why I continue to think we're going to have energy stocks. They're trading at such reasonable valuations. In most cases, 10 times to 15 times earnings, no more than that. They're paying 5 and 6% dividends and more than that. Some are paying variable dividends. So I think that when you look at the context of where am I getting income today, I mean, energy is the only sector of the 11 S&P 500 sectors that is up at all this year, or there's a couple utilities may now be break even, but there's nothing up double digits except energy. So I think that it's a place you have to be with a bit bigger than market weight until things change. And we'll see that, because if we go into a recession, which I think we're already in from all the data, and stocks get repriced to the downside one more time in July based on June 30 numbers, sometimes in some of the other charts, you see that they in a correction trade at 13 times earnings. Well, that would be 3 points down from the 16 times 25-year average. So with that in mind, we could have another leg down. I still think you can buy stocks at great prices today. And when tech stocks are now being reconfigured into the Russell 1000 value index, that ought to tell you something. Okay, it's way oversold, but don't go all in like Glenn said. You tiptoe, you buy now. You never know. Warren Buffett always said, you never know if you're going to catch a falling knife. And so you go in not with everything. You go in with some, then you go in with others. And we've been patient with new clients' money and cash just because we had to wait to see the Fed execute this policy. And I think they're batting 1,000 at the Fed for never getting it right. So I'm putting serious wagers on we are in a recession or about to be. And I think the consumer sentiment bears that out.
Thanks, Joe. Glenn, Joe, do you guys have any closing thoughts before we conclude today?
I have just a couple. I think Glenn said it well. Bonds have been awful, but I'm going to predict they're going to end up the year break even or close to it. And that's because they're oversold. They're hated, and the Fed's not raising rates to 7 or 8%. They can't. It'll blow things up. And so that would be one thing. And so the fixed income side of portfolios will essentially work itself out as rates stabilize. And I do think the Fed is not going to lower rates after the recession becomes very apparent to them in probably the third or fourth quarter. But I do think you've seen the end of increases. And so obviously it's a good time to buy some stocks today, but you have to be cautious, and you definitely want to tiptoe in dollar cost average over the next few months until we catch the bottom.
Glenn, any remaining thoughts from you?
No, I agree with Joe. I do think that my highest conviction asset class would probably be in bonds, especially from this point. I think that rates are at a point where it might be interesting to start allocating to high quality, either U.S. Treasuries or very high quality investment grade. I would not be looking at anything below investment grade or taking a whole lot of credit risk And I do think that from a secular perspective, that there's going to be winners and losers going forward as a result of the supply chain disruptions that we've seen, and also with the energy policy, not just only in the U.S. but globally. And I think that countries are going to have to rethink their energy policy and who they're dealing with. And I think that that's going to create a lot of opportunity, whether it's in nuclear or whether it's in cleaner fossil fuels. And so I think for someone to think maybe ahead or try and think, Howard Marks calls it second level thinking. First level is basically what everyone else is thinking. And if you can think it from a second level perspective, that's where you can really capitalize and make a lot of money. If you have that ability to kind of think second level and allocate to ahead of the crowd, I think that there's going to be distinct winners and losers in the environment going forward. And so to Joe's point, especially with valuations where they are, and with stocks being, having sold off so significantly, that only increases, I think, the opportunity set.
Now, we did get one last question, Joe, and I'll throw this one out to you. So again, we spent a lot of time on energy because it is very integral to where we are right now in the economy. But with the current administration in the U.S. essentially trying to get us off of fossil fuels, companies in that space are super reluctant to invest in infrastructure and build new refineries and that kind of thing. Why would that make a good investment, Joe?
Well, again, in the energy space, if you look at any of the players that are up extremely well this year, high 20, 30, 40% plus returns, I mean, they're not spending money on CapEx. And the reason is the environment politically it's a hated sector. Fossil fuels are bad. In Washington, and also is trying to get banks and others to beat them down. Don't you lend in that sector. So there's basically no CapEx. When you have no CapEx, that just means that you're gushing free cash flow and you return it to shareholders in the form of dividends and stock buybacks. And so a lot of the rhetoric coming out of Washington is totally from a replay from the 70s playbook. They wanted to have these windfall profits taxes. That was all flooded in the 70s. It was a non-starter. And so I just think you have to look at it like the cigarette industry in the 90s, post the big tobacco settlement, is you could just sit there and boring stocks are minting money. They're going to return it. And there is absolutely no way that energy can go from 70% fossil fuels in our country to zero fossil fuels overnight. It would take decades. And if they actually said they could do it, I wonder where they're going to get the lithium to power all the EV vehicles. And that is a huge thing. And I think China actually controls that market pretty significantly. So that's why I really think energy is here to stay, like it or not. And you can see that in Germany because of this whole EU posture against Russia. And we're not going to buy their gas or oil. They're actually burning dirty coal in the middle of the night and hoping no one notices. So there is a whole reset going on, and energy's at ground zero.
Yeah, and if anybody wants to hear a long form interview with somebody really smart in that space, we actually did a podcast with Recurrent, who's an investment manager in the energy space. I encourage you to check that out. So that said, folks, we're going to go ahead and wrap it for today. Again, if you would like to reach out to us, you can visit our website, wealthqb.com. You can schedule an appointment there, give us a call, shoot us an email. Always feel free to follow us on social media as well. We do more timely updates there, Facebook, Twitter, et cetera, et cetera. Again, look forward to updating our website here in the next 24 to 48 hours. There should be a lot more information out there as well. So thanks a lot, folks. We appreciate your time. And if there's anything more we can do for you, please don't hesitate to reach out. Thanks, guys.